The current live price for cbdMD Inc., ticker YCBD, is trading right at $1.02, representing an absolutely massive intraday explosion of roughly 62.83% to the upside as of this moment. You were looking at a stock that opened the session near $1.23, dipped to test the 98-cent level, and is now engaged in a ferocious battle to hold the psychological $1 line. To put this in perspective for you, most stocks move a fraction of a percent in a day. We are seeing a vertical repricing event happening in real time. If you looked away for an hour this morning, you missed a volatility spike that some blue-chip companies don't see in a decade. Now here is where the tension lies. The expectation for a company like cbdMD, a microcap in the beaten-down cannabis and hemp sector, is usually one of slow erosion. The narrative you have likely heard for the last 2 years is that the green rush is over, that these stocks are essentially dead money, and that without federal legalization, there is no catalyst left. That is the expectation. The reality you are watching on your screen right now is violently contradicting that belief. What we are witnessing is not just a random pump, it is a structural repricing based on a critical survival milestone that the market is finally waking up to. The volume today is telling the real story. We are seeing over 150 million shares traded. For a company with this float, that is an entire turnover of the shareholder base multiple times over in a single session. This suggests that the old money trapped in this stock might be exiting, while a massive wave of new speculative capital is flooding in. But why now? Why December 12, 2025? To understand this move, we have to look at the news that dropped just a few days ago, which is only now being fully digested by the algorithms and retail traders. On December 8th, cbdMD confirmed that it had regained compliance with the NYSE American listing standards. This is a huge deal. The expectation was that many of these smaller cannabis players would be delisted, forced onto the pink sheets where liquidity dies. By regaining compliance, cbdMD essentially told the market, "We are not going anywhere." They removed the imminent death discount that was pricing the stock at 60 cents. Institutional algorithms that are programmed to avoid non-compliant stocks are suddenly allowed to touch it again. You are seeing the mechanical effect of that restriction being lifted, combined with a massive short squeeze. When you see Tesla stock or Nvidia stock make a move, it's usually based on earnings or a product launch. When a stock like YCBD moves, it's often about survival mechanics. The market had priced this for bankruptcy or delisting. The reality is they just fixed their balance sheet and secured their spot on the exchange. That gap between bankruptcy pricing and going concern pricing is exactly what that 60% green candle represents. Let's look deeper at the financial reality that set the stage for this move. Back in late November, the company released preliminary fourth-quarter results that quietly defied the sector trend. While their peers were reporting revenue declines of 8 to 10%, cbdMD signaled that they were actually growing revenue sequentially. In a sector where everyone is shrinking, staying flat or growing slightly is a massive signal of relative strength. They also narrowed their losses significantly. The market ignored this news 3 weeks ago because the delisting fear was still hanging over their head. Now that the delisting fear is gone, the market is rushing to price in those better financials. It's fascinating to watch how retail investors react to this. If you're using Robinhood or SoFi Invest today, this ticker is likely flashing on your top gainers list. That visibility creates a feedback loop. Traders who don't know anything about CBD or hemp see the movement and they pile in, creating a self-fulfilling prophecy of momentum. This is the essence of modern market structure. Liquidity begets liquidity. However, we need to be very careful here. While the move is exciting, we have to look at the broader context. The cannabis and hemp sector is still incredibly difficult. Regulatory clarity is still murky. We are seeing a shift where companies like cbdMD are trying to pivot from just being CBD companies to being broader wellness and beverage companies. Their Oasis line of seltzers is a prime example of this. They're betting that the future isn't just tinctures you buy at a health food store, but social beverages you drink at a party. This is a direct play on the sober curious movement and the mainstreaming of hemp-derived cannabinoids. If you're someone who uses Schwab Intelligent Portfolios or relies on Fidelity Wealth Management for a steady, long-term plan, a stock like this probably doesn't fit your core strategy. This is high-risk, high-reward territory. This is for the individual brokerage account where you allocate capital you are willing to lose. It's closer to the volatility you might see in Robinhood crypto trading than in a traditional Fidelity mutual fund. But that doesn't mean that it's not investable. It just means you have to respect the danger. Let's talk about the macro environment for a second. We're in late 2025. The economic landscape has shifted. Rates have been a major topic, and for small companies that rely on debt, high rates are killer. cbdMD has been working to reduce their reliance on toxic financing. The fact that they survived the rate hike cycle of the last few years is a testament to management's ability to cut costs. They slashed their cash burn. That is the boring part of the story that doesn't make headlines, but it is the reason the stock is still listed today. There's also the Farm Bill narrative. The industry has been waiting for clarity on hemp-derived cannabinoids. There's a massive gray market for these products, and regulators are trying to close loopholes. The expectation is that regulation will crush the industry. The contrarian take, the reality we might be watching, is that regulation actually helps the clean players. If the government bans the shady gas station products but creates a clear lane for tested, compliant products, companies like cbdMD, which have invested heavily in NSF certified for sport protocols and proper manufacturing, stand to win. They have the infrastructure to comply with rules that will bankrupt the garage operators. I want to pause here and ask you a question about the industry itself. We talk a lot about legalization, but the real movement lately has been in these hemp-derived beverages. Comment below. Do you think hemp-derived drinks are going to replace alcohol for a significant portion of the population, or is this just a passing fad? I'm genuinely curious if you've tried them and if you think that is where the real value in this stock lies. Getting back to the price action, we have to look at the psychological levels. The $1 mark is critical. If YCBD can close above $1 and hold it for a few days, it changes the technical complexion of the chart entirely. It brings in a different class of technical trader. Below $1, it's a penny stock play. Above $1, it starts to look like a recovery play. You'll see Interactive Brokers data showing different order block sizes as we cross these thresholds. The smart money often waits for that confirmation. What is the business model actually driving this? It's not just one thing. They have the direct-to-consumer e-commerce site, which gives them high margins but requires high ad spend. They have the wholesale channel, which has been tough lately but offers scale. And they have the pet segment, Paw CBD. The pet market is interesting because pet owners are often more willing to spend on their dog's anxiety or joint pain than their own. It's a sticky customer base. If your dog stops limping because of a chew, you buy that chew forever. But let's be real about the risks. This is a company that has burned a lot of cash in the past. They have diluted shareholders significantly to get here. If you look at a 5-year chart, it is ugly. The expectation from a cynical investor is that this rally is just another opportunity for the company to sell stock and dilute you again. That is a valid fear. You have to watch their SEC filings like a hawk. If they announce a new offering tomorrow to raise capital into this strength, the stock could tumble back down. That is the game of chicken you are playing with microcaps. On the flip side, the blue sky scenario is that they've right-sized the business just as the regulatory clouds are parting. If they can get to cash flow break-even, which they have signaled is the goal, then the current valuation is incredibly low compared to their revenue. You are paying very little for every dollar of sales they generate. In a world where some tech stocks trade at 50 times sales, a consumer goods company trading at a fraction of sales looks cheap, provided they don't go bust. The self-investing crowd often gets caught up in the hype of the moment. You see the plus 60% and you hit buy. But successful online investing requires looking at the day after. What happens when the volume dries up? That is why the compliance news is so important. It provides a floor. It means the stock isn't going to zero tomorrow because of a listing rule. It forces shorts to cover because the easy short thesis is dead. We also have to consider the broader market. Today, the general indices